welcome. You're watching the Mutual Fund Show. Now, the next 20-30 minutes, we'll be having a very interesting conversation to try and understand that if, when we say more funds means better returns. Now, to help us understand this better and to get the optimum number of products in one's portfolio, Vipul Bhowar, Senior Director, Listed Investments of Waterfield Advisors, joins in. Hi, Vipul. Thanks for joining in. Vipul, one thing that we both would agree on is that diversification at the product level is important. We also do know that over-diversification may not necessarily be good for a product. How do you determine optimal diversification at a product level for investors?
Hi, Samina. Thanks for having me here. So completely agree with your thought that more the diversification, it certainly impacts returns at a portfolio level. Uh, what we generally recommend is that having a mix of diversification and concentration at a portfolio level. So be it large cap, mid cap, and small cap across market cap. It's best to have a strategy where there is some sort of a diversification and some sort of a concentration wherein we're not skewed to a particular strategy, a particular theme, but broadly at the same time we are fairly diversified across sectors. So diversification across sectors is one way to look at the strategies when building a portfolio, and diversification across market caps is something we should look at when building portfolios, and not just not just randomly diversifying by looking at the performance of the funds.
I don't want you to quantify the number of funds just yet, but would you tell me, how do you determine the optimal number of funds in a portfolio to achieve diversification without an overlap? And does that differ in terms of the quantum of wealth one has? So what I want to understand from you is, if somebody is doing an investment of, say, 10,000 rupees a month versus somebody who's doing 1 crore rupees a month, is the number of funds, should the number of funds be fewer for somebody with a smaller corpus and more with somebody with a larger corpus, or that's insignificant?
So that's completely insignificant, Samina. Ideally, the first question to look at is what should be the ideal market cap mix. Let's assume large cap, mid cap, small cap, and broadly diversified across three different market caps. The second question would be broadly in these market cap, you're okay with max to max two strategies. For example, in large caps, you're predominantly okay with having passive strategies that essentially takes care of the large cap allocation. In flexi cap, or a mix of large cap and flexi cap would be a basket which will take care of your large cap allocation. Whereas in mid cap and small cap, uh, essentially we can quantify into two strategies, one focusing on growth while the other is focusing on value. So just trying to create a balance between growth, value is something one can look at, but predominantly not more than two or three strategies in a particular market cap takes care of the overall diversification and takes care of the total allocation into a particular theme, particular sector, and particular market cap.
So are we saying that 7 to 8 funds is probably a good number across market caps and sectors for an investor to consider while building a portfolio?
Yeah. So, Samina, just to take a step forward. I mean, broadly, most uh, uh, 10,000 rupee SIP might want to still continue building a core portfolio, and then might want to look at building a satellite portfolio. For a 1 crore ticket size, they might want to create a core portfolio and a satellite portfolio together. So a core portfolio will be 80% allocation, and a satellite portfolio can be a 20% allocation. In that context, this 8 can go to 10. But broadly, if someone is just looking at focusing building a core portfolio, not more 8 to 10 strategies are enough to get that overall market cap allocation and the portfolio blend allocation.
Okay, so that is ideal, right? But we've spoken to so many people, even on the channel, when people write in with queries, they've got 40 funds, 50 funds. Every time there's an NFO, they get tempted and would, invest in one. At what stage does holding multiple funds become counterproductive due to complexity or maybe even redundancy?
So, the observation is valid. When we do come across a lot of portfolios, we see that happening. And essentially, what we do is we run an overlap analysis, and that is where most clients, everyone realizes that they have 10 different strategies, but those 10 different strategies actually hold the same 10 stocks, and that's why the portfolio has not been able to beat the benchmark. So the first thing one should look at is try to reduce overlap in the portfolio. The second reason why this kind of a phenomena happens is most of the allocation or most of the investment happens looking at short-term returns. So 1 year, 2 year, 3 returns of a strategy, and hence, there is this interest of buying into such kind of funds. And lastly, in every bull run, you have select themes which do very well. So more so to make the most of those themes, you have those thematic funds, and that's where the incremental allocation to the line item just keeps on increasing. So the idea is to first look at overlap. I think in that exercise, most clients will realize that there is no need to have so many strategies. They are replicating the strategies in a way, and that will lead to first round of consolidation and reduce the gap between a concentrated strategy and a broad-based strategy. So these two strategies or these two action points will automatically reduce the overall line items in the portfolio.
Why owning the market may be counterproductive, right? Because if you are trying to achieve returns that are better than the Nifty, I mean, that's the whole idea of investing in mutual funds. Otherwise, a simpler way to do it is to simply buy the index. Why is it important to have a concentrated portfolio which is also diversified? So now this is a little bit of a catch-22, right?
Yeah. So good question. So Samina, what happens is markets go through some sort of a shallow cyclicalities. The sectors also go through some sort of a shallow cyclicality. So in the last 4 years, you would have seen a lot of sector rotation. Sector by sector, we saw earning recovery, and now we are seeing sector over sector, some sort of a consolidation happening. To capture those themes, to capture those sectors, uh, you need some sort of a concentration.
Kshitiz, thanks for joining, and I don't know whether you heard my question, but what I'm trying to do is understand from you of how many funds are too many funds. The constant struggle for investors of building a diversified portfolio which is not overly diversified.
Hi, Samina, and there was some network issue, but now things are better. So I think very strangely, when I keep on meeting clients, and it's been so many clients we've met over a period of time. So idea is to diversify, and diversification is done to complement the existing holding across sectors, across asset classes, so that you should not have all your eggs in one basket, but you end up over diversifying portfolio. My sense is if you take equity portfolio basket only, then I think 7 funds are more than enough, which includes your tax saving funds, or let's say balance funds also. I think that's more than enough. Fixed income fund, depending on the maturity of fund which you require in your portfolio, let's say for 1 year, 3 years, 7 years, depending on that, you can have 3 to 4 fixed income funds also. So I think idea of diversification is to generate that extra alpha with reducing the risk. But when you get into so many number of funds which are having unique 300, 350 stocks, then eventually you're actually getting into BSE 500 only. Then I think it's better that you should buy an index rather than just expecting that your funds or your portfolio will beat index with a good amount of margin. And there are studies which have shown over past that over diversification is actually tapering your return down, not stepping it up.
You're so right. You can't own the market and expect to beat the market, right? Some amount of concentration is required. In some ways, also free lunch is, that's what's never available. So you've got to do a little bit of homework when you pick your fund managers to make a long-term bet. But let's quantify this, Kshitiz. Of course, Vipul and me discussed that already. But why don't you come in and tell us, what is it that you tell your clients to do? What is an ideal portfolio mix? How many funds are a good number for one to manage, not add complexities, and of course not make the portfolio redundant?
So I'll break it down to numbers. Let's say, as I said that when you look at so when normally we say that your all investment should come in one page. When it start crossing that one page, then you can't have a track of it. Irrespective of how many softwares you have, how many platforms you have, I think better is to look at a pure equity mix of 4 to 5 funds. That's good enough, where you can have maybe an index fund, a good mix of multi-cap focused fund, a large and mid cap, and depending on your risk appetite, a small, mid, or a sectoral fund. That's what you can look at. Maybe if you're in an old tax regime, you want to add a tax saver. So maybe 6 is what the count should look at. I know there are a lot of NFOs which are around the corner which keeps coming, but then If there is need or a gap, then only you add. So six is the number of fund which you should look at. So that, let's say, many of the funds will have some common stocks, but unique portfolio level stock should not be more than 140, 145, or 150 on a higher side. I think that's a focus approach which you should look at, and you should go with the flow of these funds in your portfolio, and just add or subtract only if there is a need of doing that. So I think that's the fund size you should look at as you keep on stepping up the number of funds. Because right now, last 4 years, Samina, the markets have been really good. Everybody thinks that everything is firing. So why to necessarily reduce the portfolio, or let's say concentrate it further? But as our market will keep on growing, you'll find it difficult for many funds to beat the index. So I think you should look at a limited number of funds, as over diversification and the common stocks across funds will keep on reducing the return part of the portfolio. So, and my sense is, obviously we some mutual fund we keep on talking about. On direct stock portfolio, I'm just adding that if you go more than 30 stocks, I think there are two type of risks, Amina. One is unsystematic and systematic. That's a total risk. Unsystematic risk has been taken care by 5 to 7 funds, and as I said, more than 30 stocks if it's a direct stock portfolio. And systematic risk is something that you can't avoid. It has to do with sometimes some COVID happens, some war situation, some macro things happen. So I think you can't avoid. But unsystematic risk is well taken care. But if you keep on adding more and more fund, it's like overrating or over diversifying. Then you will have 50, 100 bips, or maybe 150 bips less on what you can actually do when it comes to overall portfolio.
Right. Just one quick question, Kshitiz, on the same space. Do you believe that a larger corpus or a bigger corpus warrants more funds, or the size of corpus does not have any bearing on the number of funds that are recommended, or one requires to beat the Nifty and generate alpha?
In a country where you have 12% nominal GDP, if you're happy with 12% type of return, I think index is something which you should look at. You don't need any one of us, to look at the portfolio. But yes, I agree with you. Where the fund size is large, then maybe you can look at stepping it up, maybe by one or two funds. But you see the type of growth in overall equity assets we have seen across. So I think it's irrespective of whether you are into 20 funds or 25 funds. So I don't see the size of market is becoming nice. We have good funds with good amount of corpus in it. Sometimes, Samina, I will like to add this, that many of the mutual fund sizes where fund portfolios have become, mutual fund size has become really big. There you might find that the additional delta is not coming that effectively, which can achieve with a decent size mutual fund, because you have to take a bigger bet. Let's say if there's a fund size which is 50-70,000 crore, if you have to do 5% allocation also to a stock, then it has to be done in 2,500 crore of total buying. So in that case, you have to take a call whether further allocation you want to put into that fund, or you want to add something else in your portfolio. That is something. But I will never ask people to redeem, because the cost of redemption is a capital gain. And if you are a long-term investor, I will not ask you to redeem. But yes, over a period of time, if it's very, very highly diversified, then you should trim it a bit. That is what. But I agree with you to some extent. If the fund sizes, if the corpus size is big, then you might end up adding one or two more funds.
Wow, Kshitiz, I think you've done a good job of actually breaking it down and giving us actionables. And Vipul, you may want to come in on this one. So if somebody is watching this show and has decided or has realized that he has more than enough funds on his portfolio, there is an overlap, the cost of investing also becomes higher, rebalancing generally becomes far more complex, right? What should he or she be doing now? Should they be eliminating strategies of funds depending on performance to reduce the number of funds to the ideal 6 to 8 like we discussed? Or should they be eliminating underperformers? So do you eliminate based on repetition, or do you eliminate based on performance? Or like Kshitiz said, maybe even your personal time horizon or capital gains or period of investment becomes important. You want to quickly comment on this before we close the loop on this conversation?
Sure. So essentially, I think this is a good time to actually look back and rebalance portfolios. And firstly, the best way to start is look at overlap. And that will be an eye opener in terms of how many funds are following the same strategies. Second, of course, certainly the funds which are underperforming and funds which we've been holding for more than 3 years, and funds which are holding for a long term, over a period of more than 3 years, and underperforming, they certainly merit some sort of an exit or some sort of a rebalancing. So to answer question, first overlap, second would be underperformance, and third then would be a right balance between market caps. Whether in the last 3 years predominantly, or last 4 years predominantly, we have seen mid and small cap portfolios have done reasonably well versus the large cap portfolios. So if the portfolio is now which was 50-50, which was 50% large cap and 50% mid and small cap, in the last 4 years would have gone to 60-40, where 60% would have been mid and small cap. So that is one way to look at rebalancing portfolios. So it will be a mix of all the three parts, and that is how one should actually look at rebalancing the portfolio.
Okay, Kshitiz and Vipul, I think we'll close out this one. Let's try and get a sense of what and how should one approach total market funds versus multiple funds, right? I know for a fact that when investors are looking to diversify at an asset level, if the corpus of investment is small, you could consider investing in a hybrid strategy. In that way, you get equity and debt, and that's a healthy mix. Those funds also do quite well, and especially if you don't have somebody helping you with asset allocation, these become good funds. Can the same logic apply, Kshitiz, to funds in the equity space, where you invest in one fund, for example, a flexi cap fund that would give you exposure across sectors and across market caps? Or do you say, you know what, that may not be ideal? Let's look at funds across market caps, and let's look at funds across themes or investment styles. How does that work?
That's really nice, Amina. And I keep on, sharing on various platforms that just don't look at that you are into flexi cap or a multi cap or small or mid cap. On a portfolio level, just look at how much large cap, mid cap, or small cap allocation you have. And this is very important. Sometimes we feel that, boss, I should have a unique small or mid cap fund. But if you actually see small or mid cap fund allocation, you get through large and mid cap also, flexi cap also, multi cap also. At the same time, I watch for that one should not stick to only one style of investing in terms of, let's say, you have a small corpus, then you should take one or two funds. You should have at least 3 to 4 different funds. And yes, it depends on totally on your age, what type of, how much risk you can take and your risk appetite, how much you can do. Second important thing, Samina, here is that when you choose a fund for your investments, you should be wary of the fact that you are coming here for at least 5 year plus time horizon, and depending on what type of goals you're aligning with those funds, I think that also helps. So you should not be looking at only that if there is one fund I should do flexi cap only or multi cap only. You should, if the corpus is small also, I will always tell somebody is having 10,000 rupees to deploy on a monthly basis also, they should look at adding 2,500 against 3 to 4 funds. That's one should approach, how one should approach.
Do you agree with that, Vipul? Versus a multi-cap or a flexi-cap fund versus multiple funds? Is that an option? I'll complicate this further. Maybe a couple of multi-cap and flexi-cap funds, or just multiple funds. How does one play this? Because the corpus is small. If you are getting the diversification across stocks and sectors and market cap, then why invest in multiple funds and complicate life?
So Samina, the right advice would be to have a mix of diversification and concentration. So while flexi cap strategies would diversify across market caps, and that plays very well across cycles, a concentration will certainly add alpha to the portfolio. So a fair advice would be to have both, have a mix of diversified strategies through a flexi cap strategy, as well as have something which is concentrated, a dedicated mid cap strategy, a dedicated small cap strategy. That would be a right balance to generate alpha.
That's probably the right way to generate alpha. Let's talk about this a little bit more, right? And I want to talk about a behavioral aspect, because Vipul, which I think we all would agree that investing is more behavioral and emotional than actually physical in more ways than one. How Do you think that investors are more likely to stick to their financial plan when the portfolio is simpler, or as opposed to having multiple funds, over diversification, diversification? Simply put, the more complicated it is, the lesser chance of sticking to the plan. Do you agree with me, Vipul? And that hence merits another reason of why you shouldn't have too many funds.
So completely agree, Samina. Portfolios which or clients which have actually panicked and have exited are those where have had over diversification, and empirically when the markets are doing very well, we see no reaction. But when markets start in the last few months, when the markets were volatile, there is seems some sort of panic to rebalance portfolios. So a plain simple strategy. Across different market caps, a plain strategy across funds, some concentrated bets, some diversified bets is enough to plan a strategy to compound the portfolio over a period of time, and of course to beat certainly beat alpha.
Well, Kshitij, how do expense ratios and fund management fees impact the decision to consolidate investments into fewer funds versus diversifying across too many?
So, SEBI has clearly defined, depending on the fund size, there's an expense ratio which one has to charge. And as the fund size keeps on growing, you have expense ratio which is going down or coming down. At the same time, there is an index fund, Samina, where expense ratios are vis-a-vis active funds are much lesser, or maybe half of the cost vis-a-vis your active funds. And many of the investors do look into it because, whether it's 50 bips, 40 bips, it do compounds over a period of time. But my only suggestion here is that people who have time and can do it themselves, only they should look into this part, because what becomes important is when they take a call on that I am buying a fund, but let me look at a fund which is with less expense, because I'm here for 10, 15, 20 years, and even 50 bips will compound for a long term. I think that's a wise decision which people take, and nowadays there's enough transparency of data point which are there, so people do take into account, and that's how we have seen a little bit much more traction towards at your index fund, because their expense ratio is less, and traction towards those funds which are having low expense ratio. But my submission here is, Samina, this is very important for everyone to understand that sometimes a fund size which has become very big, as I said earlier, they are not able to take bets into smaller or mid cap capish companies, whether flexi cap or multi cap, beyond one stage, because let's say, as I said, for a bigger fund, for 5% also, it becomes huge corpus. And then at that time, they have to go a little conservative. And you see that irrespective of last 10 years, 5 years return looks good. But often, if you actually analyze last 1 year, 1.5 years return, 2 years returns, for many of the bigger funds, it's in second or third quartile, not in the first quartile, which were doing really well earlier. So I think much bigger fund size, my personal view is that one should look at fund size between 20 to 30,000 crore is the right fund size which you can look at. Lesser, if there is a good fund, is also a good size, but something which is going above 35,000 crore, I think there you find that performance is taking a bit of a slack, because as the fund grows, your at fund manager level also, at any to move one needle, let's say you not buy a 0.5% or 1% in a bigger company, then you have to buy a bigger chunk. So I think people do take a call on expense ratio, but then they should take this into account, that what is the sweet spot, and how they can manage between the expected return and the expense ratio what they are paying right now.
Right, too large a fund makes it very difficult for the fund manager to navigate the markets and, of course, make concentrated bets where the impact of that will be material. One last question before we wrap this conversation up, Vipul. For individual factors, we've talked about the ideal portfolio size and the factors that one needs to track when they're rebalancing at this stage. But personal, objective, and subjective in nature, risk appetite, financial goals, and time horizon. How important are they in terms of dictating the choice between few broad-based funds and a more segmented approach in that sense?
So certainly, Samina, risk is individual, and of course, depending on the risk profile of the client, the market cap allocation varies. Someone with an aggressive tilt would generally prefer one third, one third, one third, which is one third large cap, one third mid cap, one third small cap, and someone who is conservative might want a 70-30, 70% large cap and 30% mid cap. So risk is dependent on the individual. Of course, time horizon is something which in equities you need to have minimum of 5 to 7 years for portfolios to perform and for returns to compound. So that is on time. Uh, but broadly, what I've seen is that as portfolios get built, one thing which most clients don't spend time on is in actively rebalancing portfolios. What happens is over a period of time, once a portfolio gets built, they generally keep on holding and don't monitor it actively, be it on performance, be it on expense, and that's where constant monitoring and constant active rebalancing in between 3 and 5 years merits to do that, and that will actually help build long-term compounding.
You're right, Vipul. Thank you, Kshitiz. Great having both of you on the show. So, of course, you don't want to over-diversify, build a diversified portfolio, rebalance it, not too frequently, but frequently enough. Don't buy a fund, go invest in a fund that's too large, but not in a fund that's too small. So, lots of ifs and buts. And if this is your full-time job, that's good for you. If not, you should be seeking help from your financial advisor to actually build the optimum portfolio, because while investing is important, reviewing it is also equally important. With that, it's a wrap on this edition of Mutual Fund. Thanks for watching. A lot more programming on the other side, so keep it with us.